Good afternoon, everyone. The purpose of this assignment is to obtain greater comfort making the major financial decision for business. The CEO has given a project to assess whether an investment should go ahead. The content of this presentation consists of executive summary, introduction, four main investment appraisal techniques, weighted average cost of capital calculation for green food places, and how NPV and playback period would appraise the proposal investment. With projected cash flow, the situation if cost capitals were 20%. Conclusion. Green Food Place is a UK incorporated and UK tax residents fast moving consumer goods FMCG company which makes healthy snack bars. It is considering expanding its product range to include vegan meats, substitute foods, and specifically starting with a vegan steak. It has spent 375,000 so far on developing a recipe and doing market research to determine whether there is a market for such a product. We will need to purchase a new machine to mix and press the patty, which will cost us 910,000 plus the cost of wages of a supervisor, marketing, and materials. The market value of the share is £3 per share, and there are 5 million ordinary shares in issues. Dividends are expected to continue at 50p per share for the foreseeable future. The company has 10 million in irredeemable loan capital with an interest rate of 5%, and it is currently quoted at £90 per 100. The tax rate is 20%. We need to find out if the company investment should go ahead. Okay, on behalf of Green Food Limited, I would like to welcome you today. For those of you who don't already know me, my name is Koghilan Mahendiran and I am working as a business manager. Did you know that financial decision is important to make wise decisions about when, where, and how should a business acquire fund? Because a firm tends to profit most when the market estimation of the organization's say expands, and this is not only a sign of development for the firm, but also it boosts investors' wealth. I'd like to take this opportunity to talk about financial decisions on an investment, whether it should go ahead. Critical evaluation of the four main capital investment appraisal techniques. ARR method alone considers the accounting concept of profit for calculating the rate of return. Moreover, the accounting profit can be readily calculated from the accounting records. This method satisfies the interest of the owners since they are much interested in return on investment. This method is useful to measure current performance of the firm. Disadvantages of this method ignores the time factor. The primary weakness of the average return method of selecting alternative use of fund is that the time value of fund is ignored. Payback period requires a less cost, time and labor when compared to other method of capital budgeting. This method reduces or avoids the loss through obsolescence since shorter payback period is preferred to longer payback period. It gives much importance to the speedy recovery of investment in capital assets. Disadvantages: it overlooks the cost of capital, which is a main factor in sound capital budgeting decision. This method does not consider the cash inflows arising after the payback period. The obvious advantages of the NPV method is that it takes into account the basic idea that a future dollar is worth less than a dollar today. In everyday period, the cash flows are discounted by another period of capital cost. The biggest disadvantage to the net present value method is that it requires some guesswork about the firm's cost of capital. Assuming a cost of capital that is too low will result in making suboptimal investments. Assuming a cost of capital that is too high will result in foregoing too many good investments. IRR is measured by calculating the interest rate at which the present value of future cash flows equals the required capital investment. The advantage is that the timing of cash flows in all future years are considered, and therefore each cash flow is given equal weight by using the time value of money. A disadvantage of using the IRR method is that it does not account for the project size when comparing projects. Cash flows are simply compared to the amounts of capital outlay generating those cash flows. This can be troublesome when two projects require a significantly different amount of capital outlay, but the smaller project returns a higher IRR. Calculation of WACC and evaluation. WACC can be used as a hurdle rate against which to assess ROIC performance. It also plays a key role in economic value added calculations. Investors use WACC as a tool to decide whether to invest. The WACCs represent the minimum rate of return at which a company produces value for its investors. The cost of capital is the expected return to equity owners or shareholders and to debt holders. So, WACC tells us the return that both stakeholders can expect. WACC represents the investor's opportunity cost of taking on the risk of putting money into a company. 12.08 is the WACC. The weighted average cost of capital WACC is an important financial concept that is widely used in financial circles to test whether a return on investment can exceed or meet an asset, project, or company's cost of invested capital, which is equity and debt. A company's WACC can be used to estimate the expected cost for all of its financing. In theory, WACC represents the expense of raising one additional dollar of money. For example, the WACC of 12.08 means the company must pay its investors an average of 12 pence in return for every £1 in extra funding. It is essential to note that the lower the WACC, the higher the market value of the company. Projected cash flow statement. The calculation of NPV and PP. The present value is the part of the net present value formula where projected cash flows for each year are discounted by the rate. The resulting net present value will tell you whether you can expect to get a positive or negative return on your investment. Based on looking at the asset's projected cash flows, one NPV considers the time value of money translating future cash flows into today's dollars. Two, it provides a concrete number that managers can use to easily compare an initial outlay of cash against the present value of the return. A project or investment's NPV equals the present value of net cash inflows the project is expected to generate minus the initial capital required for the project. During the company's decision-making process, it will use the net present value rule to decide whether to pursue a project such as an acquisition. A positive net present value indicates that the projected earning is generated by a project or investment. In present pounds, exceeds the anticipated cost. Also in present pounds, it is assumed that an investment with a positive NPV will be profitable and an investment with a negative NPV will result in a net loss. As you can see on the first table, NPV of the project is positive with £315,850, suggesting that the investment is worthwhile using 12.08% discount rate. And the second table, NPV of the project is negative with 41,356, suggesting that the investment is not worthwhile using 20% discount rate. As you can see, the payback period for the project arises through 4 years, year 4, 45 weeks through the year. So the payback period is equal 4 years and 45 weeks. Type of finance available. As you can see, the second one, angel investors. Angel investors are wealthy individuals who invest their own money in exchange for a share of the business. They generally want to be involved in business decisions and they may want to cash out after a few years. It will help if you can present a profitable exit strategy for them. An angel investor might be someone who wants to invest in your industry or your community. Advantages of business angel financing is access to BA mentoring or mentor management skills, no payments or interest. Disadvantage of business angel financing is giving up a share of your business, less structural support available from BA than from an investing company. The last one on the crowdfunding suggests that equity crowdfunding allows you to raise the funds from the public in exchange for unlisted shares, which is an equity in the business. This is generally for a consumer products or services, not B2B. And you'll do better if there's a wow factor to what your business is planning to do. The advantages can be fast way to raise finance with no upfront fees. Pitching a project or business through the online platform can be a valuable form of marketing and result in media attention. The disadvantages are failed projects risk damage to the reputation of your business and people who have pledged money to you. If you haven't protected your business idea with a patent or copyright, someone may see it on a crowdfunding site and steal your concept. Getting the reward or returns wrong can mean giving away too much to the business to the investors. Venture capitalists, professional investment companies that invest their clients' money in exchange for a substantial share of the business. VCs prefers to invest in companies that they expect to deliver massive and preferably fast growth. The advantages are business expertise. Aside from the financial backing, obtain a venture capital financing can provide a startup or a young business with a valuable source of guidance and consultation. Additional resources. In a number of critical areas, including legal, tax, and personal matters, VC firms can provide active support, all the more important at a key stage in the growth of young company. Connections. Venture capitalists are typically well connected in the business community. Tapping into these connections could have a tremendous benefits as well. The disadvantages, loss of control. The drawback associated with equity financing in general can be compounded with venture capital financing. You could think of it as equity financing on steroids. With a large injection of cash and professional and possibly aggressive investors, it's likely that your VC partners will want to be involved. The size of the stake could determine how much they say have in your shaping your company's decision direction. Um, Minority ownership status. Depending on the size of the VC's firm stake in your company, which could be more than 50%, you could lose management control. Essentially, you could be giving up ownership of your own business. Lending from friends and families. Those loved ones who support your dreams with their own money. Many budding business owners turn here as a first option, and some do it as the last resort. The advantages are flexible options like entrepreneurs and those with poor credit may struggle to secure a loan through traditional means. Additionally, private lending from friends or family can allow for more flexible repayment schedules. Lower interest rate. One of the benefits of borrowing from friends and family is that you can typically land a lower rate. Lenders benefit. Along with the satisfaction of helping a friend or family member in need, investors may enjoy being part of the business formation process while earning returns similar to those provided by other investment vehicles. Cons. Lack of clarity. For example, friends or family members who lend you money may assume their financial investment gives them a stake in their company or a voice in daily operations. Tax issues. In their eagerness to help friend or loved one in need, lenders may neglect to consider the effect a loan will have on their tax liability. Social awkwardness. Of course, accepting loans from loved ones isn't just problematic from a legal perspective. Mixing business and pleasure can also complicate routine social interactions. One of the disadvantages of owing money to loved one is that it may open up unwanted dialogue about your spending habits, whereas a bank wouldn't tell you to stop going out to dinner or discourage you from buying a new car. Lenders who are also friends or family may criticize you for spending money when you have yet to repay your debt. Okay, let's have a look at the conclusion. NPV of the project is negative with minus £41,356, suggesting the investment is not worthwhile using 20% discount rate. NPV of the project is positive with £315,850, suggesting the investment is worthwhile using 12.08 discount rate. Payback for the project arises through year 4 equals approximate 45 weeks through year 4, so the payback period is 4 years and 45 weeks. And based on the finances available, I would not recommend crowdfunding as it may not gain the amount required and giving away too much. But I suggest that the venture capital might be the best of to look out for as they prefer to invest in companies that they expect to deliver massive and preferably fast growth. Thank you.